Learn how to select and blend core dividend ETFs to create a foundation for long-term passive income and compounding returns. Let's break down the simple steps to building a reliable dividend ETF portfolio so you can make your money work for you year after year. Before we dive in, remember, this video is for educational purposes only. It's not financial advice. Always do your own research and consult a professional before making investment decisions. Why does building a dividend ETF portfolio matter, especially for those seeking steady income? Here's the truth. Many investors want to create a stream of passive cash flow, but picking individual stocks can be risky and overwhelming. Dividend exchange-traded funds, or ETFs, can provide income diversification and lower risk, all in a single investment. They're a great entry point for beginners and a smart core holding for more experienced investors. Let's explore how you can build a solid dividend ETF portfolio in clear, manageable steps. First, let's clarify a few key terms you'll hear throughout this video. Dividend is a portion of a company's earnings paid out to shareholders, often quarterly. When you own dividend-paying stocks or ETFs, you receive regular payments, your share of the profits. Dividend yield. Is a measure of how much cash flow you get from your investment, shown as a percentage. For example, if an ETF has a 3% dividend yield, you'd receive $30 per year for every $1,000 invested, assuming the yield stays the same. Payout ratio is the percentage of a company's earnings paid as dividends. A lower payout ratio usually means the dividend is more sustainable, while a high payout ratio could be a red flag if profits drop. And finally, diversification. Means spreading your money across different companies, sectors, and sometimes regions. This reduces your risk. If one company or sector struggles, others can balance things out. Now, let's get into the practical steps, starting with your foundation. Core dividend ETFs. Step 1. Choose a core dividend. ETF***. Your portfolio's foundation should be a core dividend ETF. This is a fund that holds a broad basket of companies known for paying reliable dividends. It provides instant diversification and is designed for stability. A classic example is the Vanguard Dividend Appreciation ETF, ticker symbol VIGVIG, invests in high-quality U.S. companies with a track record of growing their dividends for at least 10 consecutive years. Think of companies like Microsoft, Johnson & Johnson, and Procter & Gamble. These are established businesses that tend to weather economic ups and downs. Another popular choice is the Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD focuses on companies with strong fundamentals, solid dividend yields, and consistent dividend payments. Its holdings include blue-chip names like Coca-Cola and PepsiCo. What's the difference? VIG focuses more on consistent dividend growth, while SCHD targets higher current yields with an eye on financial health. Either can serve as a strong core, or you can blend both for added balance. Step 2. Add exposure to high-yield dividend. ETFs***. Once you have your core, you might want to increase your income by adding a high-yield dividend ETF. These funds focus on companies paying higher than average dividends, but often with slightly more risk. For example, the Vanguard High Dividend Yield ETF, ticker VYM, holds companies with above-average dividend yields. Its holdings include banks, telecoms, and energy companies, sectors known for higher payouts. But a word of caution, higher yields can sometimes signal higher risk. Companies with unsustainably high payouts may cut their dividends if profits decline. That's why it's important to look at the payout ratio and the overall quality of the holdings. Blending a high-yield ETF like VYM with a core ETF like VIG or SCHD can give you a balance of income and stability. Step 3. Consider international dividend ETFs***. To boost diversification and reduce your reliance on a single country, you can add international dividend ETFs. These funds invest in companies outside the United States, often in Europe, Asia, or emerging markets. A leading example is the Vanguard International High Dividend Yield ETF, ticker VYME. This ETF holds large companies from around the world that pay above-average dividends, like Nestle, Toyota, and Royal Dutch Shell. Adding an international dividend ETF can help protect your portfolio if the U.S. market underperforms or if the dollar weakens. It's a way to tap into global income streams. But remember, international stocks can be more volatile and carry currency risk. For most investors, a modest allocation, say 10 to 20%, can provide meaningful diversification. Asterisk, asterisk. Step 4. Balance for your goals and risk tolerance, asterisk, asterisk. Every investor is different. The right blend for you depends on your goals, how much income you need, and your comfort with risk. If your main goal is stability and long-term growth, you might allocate most of your portfolio to a core ETF like VIG or SCHD, with a smaller portion in high-yield and international ETFs. If you need more current income and can handle a bit more risk, you might tilt more toward high-yield funds like VYM. Here's a sample allocation for a balanced approach. 60% in a core U.S. dividend ETF, such as VIG or SCHD, 20% in a high-yield U.S. dividend ETF like VYM, 20% in an international dividend ETF like VYMI. This isn't a recommendation, just an example to get you thinking. Your mix should reflect your own needs and preferences. Asterisk, asterisk. Step 5. Reinvest dividends for compounding growth. Asterisk, asterisk. One of the most powerful features of dividend ETFs is the ability to reinvest your dividends. When you use a dividend reinvestment plan, or DRIP, the cash payouts you receive are automatically used to buy more shares of the ETF. This creates a snowball effect. Over time, you own more shares, which pay out more dividends, which buy even more shares. This compounding can significantly boost your returns, especially if you start early and stay invested for the long term. Many brokerages offer free dividend reinvestment plans. Check with your provider and consider enrolling, especially if you don't need the income right away. Asterisk, asterisk. Step 6. Monitor and adjust your portfolio, asterisk, asterisk. Even a reliable dividend ETF portfolio isn't completely set and forget. It's important to check in periodically, maybe once or twice a year, to make sure your allocation still fits your goals. Watch for changes in dividend yield, payout ratios, and the overall health of your ETFs. If a fund cuts its dividend or changes its strategy, you may want to adjust your allocation. Rebalancing is also key. If one part of your portfolio grows faster than others, you might need to sell a bit and buy elsewhere to keep your risk in check. Let's recap asterisk, asterisk. Building a reliable dividend ETF portfolio can help you generate steady income, diversify your investments, and harness the power of compounding. The key steps are: 1. Start with a core dividend ETF for stability. 2. Add high-yield dividend ETFs for more income, but watch for risk. 3. Include international dividend ETFs for broader diversification. 4. Balance your allocation based on your personal goals. 5. Reinvest dividends to grow your portfolio faster. 6. Check in and rebalance as needed. By following these steps, you create a solid foundation for long-term passive income without the stress of picking individual stocks. If you found this guide helpful, consider liking this video and subscribing to the channel for more straightforward dividend investing tips. Got questions or thoughts about building your own dividend ETF portfolio? Drop a comment below. I'd love to hear your approach. Remember, investing is a journey, not a race. Stay patient, stay diversified, and let those dividends work for you. Thanks for watching.